Hello, my name is Keith Richards, and I'm Portfolio Manager and President of Value Trend Wealth Management. And welcome to the Smart Money, Dumb Money show. This is a weekly blog video that I do, and I try to keep you up to date on what's going on in my mind, both from recent occurrences on the market and looking forward. And that's really the subject of today's video. We're going to look at some of my past calls over the past 13, 15 months or so, and the calls that were dead on and good, the calls that were pretty good, and the calls that weren't so good. I like to fully disclose how I do things, and I use the blog and these videos to do so. And I like to be accountable. Everybody likes to talk about their winners. There's something funny about my industry. They don't often print performance results, and many people don't ever talk about their losers. But I think it's important that all of us look at our losers and see where we went wrong. Hopefully we have more winners than losers, because that's the name of the game. So let's get on with it. I'm going to share my screen right now, and I'm going to bring you to this week's blogs. So the first one I want to look at was actually my second blog of the week, and it's looking back at my good calls and bad calls. So one of the things that Value Trend has been harping on really since very early in the summer, I think it was around June, July, was oil. And this is that time period right there around June, July, after the COVID crash. It recovered to a point and then sort of stayed flat. Now, this is the actual crude oil itself. It's the commodity. It's not the stocks, but the stocks tend to follow the commodity. We made a call. Technically, I felt it was undervalued, and I noted a few of my blogs. You can click on them here, where I outline the reasons for this. But in a nutshell, we were looking at the oil sector, particularly in October. We bought aggressively into the sector. We dipped in a little bit in the summer. The reason we were buying is because we felt that the usage, and by the way, the stats we just read today backed up our belief that the usage in India and China were ramping up despite the big green movement that seems to be happening in North America and Europe. So the concept here was that this is a commodity that's being overlooked, and there was too much focus on solar energy and whatnot, and we were right. We were buying in the low 40s, and it's now in the mid to high 50s. So that's been a good trade, and just this week we've really seen that sector take off, and we think there's more room to go. I have a $65 approximate target on oil. We were also very bullish on value stocks, and again, I've got a couple of links here on the blog that you can click on to see the blogs where I was talking about value stocks. I only note a couple of the blogs on these notes. I blogged a lot about value stocks, and I blogged a lot about materials and what we're calling reflation stocks, or inflation-driven stocks, because we think inflation is coming down the road based on all the money printing and low interest rates. So one of the sectors we really harped on was base metals. We have a position in base metals. I think it's around 10% of the portfolio, and we have about 10% in oil, by the way, which is also a reflation type of play. But this is the metal area, and you can see there's April, and it's been an outperformer. It performed well over the summer, but it really started to arc up in sort of October and on, and that's because as you'll see on the next chart, another call I made was that the tech stocks, the FANGs and whatnot, would lose steam. And I made this call pretty darn accurately, if I do say so myself. I made the call in September, and this is literally they peaked in August. And this is Amazon, and you can see literally gone nowhere. Now, a couple of the tech stocks have done okay. I noticed Google's made a new high, but most of them, if you look at Netflix and all them, they've really gone quite flat. Now, the other side that I was very bearish on and correct on the call was the stay-at-home stocks. Things like Zoom, which I'm using to record this meeting. It's a great product, but it got overvalued. And so did Peloton, the people that make those exercise bicycles and whatnot. I mean, these stocks, sure, everybody's indoors and has to work out and has to use Zoom and etc. But it's all about valuation and overbought status. And I didn't zoom, I blogged on this topic multiple times. One example was given here. Okay, so I said, get out of the text, get out of the stay inside, and move into things like materials and oil. A neutral call that I made. I was pretty right on this, but there was some caveats to that being correct. So my neutral call was that I felt that in November, actually, sorry, March, on March 16th, I was stating unequivocally that this market was not one to sell into. The market was crashing hard, as you can see here. This is the March of 2020. And on the 16th, which was right around this point here, I felt that it was capitulating. I was waiting for a MACD signal. Now, I was correct. I said, don't panic, don't sell. And that was a good call to make right here because it ended up going up. Now, what I also said, and this is the part where I was maybe a little incorrect, in that I was comparing this crash that we just went through in March of 2020 to most bear markets. And this is the 2009 bear market. And you can see it, as most market crashes result in, it formed a complex bottom. This is sort of a head and shoulder look to it. So there was a neckline and a breakout. You can see a complex bottom means it makes multiple attempts before it finally breaks out into a new bull market. That is what I anticipated for the March crash, and in fact, it just went straight up with no consolidation and made new highs before you could say Bob's your uncle. So I was right about not panicking. I was right about this. We probably had seen the bottom, but I was waiting for some ratcheting up and down to try to play that. We legged in at Value Trend. It's our strategy. We don't make guesses that this is the bottom. And if we had made that guess that was the bottom on March 16th, and we gone in, full in with both feet, then we would have done much better. But we're not that kind of investor because we go by history, and history shows that most markets don't look like this when they make a bottom. This one does. If I turn the clock back, I would say, well, maybe because of the ferocity of the sell-off, I could have been a little bit more aggressive stepping in. But we bought in, and we spent most of our cash by the time it crossed the 200-day moving average up here. Okay, so that's neutral, we'll call it. Good call not to sell, bad call not to buy all at once. Bad calls. So I was bearish on the Loonie. I wrote a blog in January, very beginning of the year in 2020, and I thought at the time that this line here is 77 cents, and I felt that the market has had the Loonie, I should say, versus the U.S. has had so much trouble in the past breaking 77 cents. I didn't think it would break through, and I was wrong because it's now pushing 79. There was some reasoning behind the technicals as well, because we really haven't had a very responsible government when it comes to many things, and I outlined them in the blog here, and you can click on these and you can sort of see the backing for that comment. It's not just me that feels that way. So final thing I was I guess incorrect on was the influence of the FANG stocks, the Facebook, Apple, Amazon, whatnot, on the markets. I felt that because the markets, these stocks would do this, like Amazon, and go sideways, and I was right about that. But I felt that because they are so heavily weighted on the stock market, that the market itself would be kind of flat, and that was most definitely not the case. As we know, the S&P went on to new highs because markets rotated in a big way into, luckily, the stuff that I was buying. So it turned out to be a good trade for me, but I felt that the index would not be so well off. I was still happy to hold the stocks that we held because the value sectors and the oils and metals outperformed the broad market anyway. So I was happy with our performance. I just wasn't calling the broad market correctly at that time. So those are my good and bad calls. One call for this year that I'm making right now is that I think that consumer staples, when you see consumer staples, should be on your radar. I think consumer staples are looking technically attractive right now. And unlike buying a stock like Tesla with a PE ratio of 200 times, or even Amazon, it's still trading around 70 or 80 times forward earnings. I mean, these are expensive stocks. There's a lot of good value in some of these staple stocks. This is a staple ETF, and you can see it's on an uptrend. It's still above the 200-day, and it's approaching that. And I feel that there's a real argument to be made to start legging in. Remember, we never buy all at once, to staples. So we bought one position in staples recently, and we'll probably end up buying more. This is not a stock recommendation, so please do not take this as advice, but it's one of the staples, that consumer staples that make up that index. It doesn't have the same pattern as you see in the index. It's Kraft. They've had real problems over the years, but the stock to me is starting to look, like it's building a base. You can see that's kind of a head and shoulders, angular head and shoulders look. I think if it can break 36, then it could be technically positive and could have some upside, maybe into this level up here, which probably would be a good trade. It would be probably a 15% upside plus a dividend. One stock that we did buy, I'm going to move forward and type it in. So again, not a recommendation, but we bought Coca-Cola. It's on an uptrend. We bought it on this touch of this trend line here, and we like the stock. So that's another, you got to pick and choose your staples. But if you're wise and diligent, you can find some real value there. And I think that's a sector that the market will rotate into if and when, I think it's more of a when than if, the technology and overbought stocks, such as the solar panel stocks and the EV stocks, start to round over. This summer, you could see a rotation into things like utilities and staples and sectors like that. Well, thank you very much for watching. I will point out that if you are interested in portfolio management services that use sector rotation, well, that's what we do. And we've proven in sideways and bear markets that our strength is in identifying these changes. Anybody can make money in a bull market. Our forte is performing well in a soft market. So we're very happy to talk to you about your portfolio if you feel that you would like some help over the coming quite probable uncertain times. Thanks for watching.